All right, we're back in Generational Gains. I'm here with my son, Carson Herlean, my oldest, and myself, Greg Herlean. Today, excited to talk about a subject that comes up, I feel like more often than not, the great debate. This is the great debate, I think, for people when we're with them. They ask us, what is better? Is IBC better? This infinite banking concept better? Is self-directing better? But this is when I call it the debate, I think it's the debate on as far as people, when they see us and hear our messages, they ask us, well, which one's better? And so we just want to talk about that, talk about the strengths and weaknesses, pros and cons of both, and maybe how they can also work together, and maybe debate it a little bit, fight for which one we think is better. But I think it's also a good place to start to share when people see us talking or do podcasts together. I think it's a natural thing. They immediately begin with, how do you like that your son works for you? and he doesn't work for me.
How often do you get that?
Often. Well, for lots of reasons. And I'm honored that people think that.
Yeah,
and I think it's great. Partly because you're having so much success. They're like, he must be working with his dad. But that being said, they see us do podcasts, and so they think naturally that we work together. And we do a couple things together, I would say, but in general, I'd say we spend 97% of our time doing different things. We, have our own businesses, our own clients. We don't really refer each other business. If someone comes up with some questions and or wants to, they'll come my way, and vice versa. But it's not like how you've built your business, nor is it how I'm growing my business.
Yeah.
So I just wanted to establish that first. So this can be actually a healthy debate and or discussion about the pros and cons and which one's better. So I think let's start with something let's start with which one's better. Let's just I want you to tell me, I want you to tell us why. Let's not do pros and cons yet. Let's just jump into. I assume you think IBC is better than self-directed. And I know you like self-directed. I know you do it. So we'll establish that we both do both things.
Yeah.
But let's just take a hard stance right now.
Yeah.
Why is IBC, infinite banking concept, which you've heard about in previous podcasts, why is it better than self-directing? Give it to me.
And I would add that the more I've studied money, the more education I've done, the more open-minded I've become. I feel like I've read so many things about different types of financial strategies that now I'm very open-minded to everything, and I feel like everything works. So I will say that too, just like you did. But I think if I had to choose to contribute to a whole life policy or a Roth IRA, I think I would do a policy.
Why?
And I think I would do a policy because I want to buy real estate, and I want the tax advantages from real estate. And I think I want most of my wealth to be stored in real estate. So because of that, I want the tax advantages from the real estate. I don't want to do it in a Roth. And I want to do it through a policy because I'm going to get the policy. I'm going to get guaranteed growth there. I'm going to have a death benefit. I'm going to be protected with my money and have real estate at the same time. And so it's a more efficient way to own real estate than to own it outside of a policy. And because of that, and plus a $6,000 a year Roth IRA contribution, or a backdoor Roth IRA and put in 40, 50 grand a year, I also can't even buy more than one property a year with that. I could buy more outside of it. So why not just go all in on the policy?
It's a fair thing. I mean, you've outlined several good benefits of a policy, insurance policy. I would say a self-directed IRA is better than IBC because, especially if done inside of a Roth IRA, it is completely tax-free. 100% of your gains, 100% of dollars coming out, it's all tax-free. So that's my number one reason it's completely tax-free, especially if you're able to get it all into a Roth.
Yeah.
And number two, this is a strange one probably for most, but a retirement account is like, it's kind of like putting a little bit of handcuffs on you. Yeah. Now I know that doesn't sound great for most listeners. You are able to use your money how you'd like, unlock your money, but I actually like that my clients that invest their money in whatever they want can't actually touch it for a long time. And I like that selfishly because I get to see then people compound or grow, or even if it just sits and invests and does nothing, you don't add anything else to it, you can't touch it. In an insurance policy, I've done this as well. I've bought an IBC policy, one of the first ones, bought into concept, used it as a bank account, put my cash in, took it out.
Forgot about it.
No, took it out. Took it out, all the cash value, purchased something with it, didn't pay anything back, not $1. Kind of defeated a bit the purpose. Didn't pay back the loan. Now this, you can do this obviously, but now it doesn't work the way it was structured to be a bank and to put that money back in the account and compound. So
there's added risk.
There's maybe not even just risk. There is some added, I'd say added risk, but I think it's more of there is a little less flexibility with the self-directed, but I look at that as a positive because it makes somebody really save. And the reason why that's important today is people aren't saving, they're spending. So that's my pitch on self-directed.
There's less flexibility in the IRA, like you just said, but there's also less flexibility in a policy because, well, there's a lot of flexibility with how it's structured, but there's less flexibility in terms of how much you put into it. Once you set it up, you can't just stop it. You got to keep funding it every year. Maybe after 10 years you can stop, but that's a long time to be required to put money into it before you lose it. Whereas in an IRA, if you don't put into it in a year, you're fine. Who cares?
That's right.
So you have flexibility on when you do it versus when you don't, whereas in a policy, you don't. If you start it, you start it, you're going to do it. And if you stop it, you're going to lose out on a lot of the money. So you're screwing yourself.
You got to keep contributing. I mean, that's another.
You do.
So he's giving me another bonus point for why self-directed is better.
Yep.
And we're going to get to how they work together again, but that is a positive as well.
It is a positive for you, but at the same time, I think both these strategies fit into a larger overall strategy. And I think if you are planned and strategic around your entire strategy, around everything you're doing, then you are planning to fund a policy for 10 years, at least. You should be. And you know pretty much how much you're going to be putting into it every year. And you know when you're going to buy and make investments. And so if you are a strategic individual and you have everything planned out, then I think a policy would be better. But if you don't know what you're going to do and you just want to put a little money aside here and there and invest it, then an IRA might make more sense.
Because I don't disagree. I think we can maybe be more difficult on each other at a later point because we're not being too difficult on each other. There's a lot of things you said I think that we can unpack or talk about. One of which, the importance of meeting with your financial advisor or CPA, a tax person in your life, or your financial team, at least, in my opinion, twice a year. Quarterly would be awesome, but most people don't even do it twice a year. Maybe it's the tax time. But having a financial plan and being able to use these different vehicles to grow your wealth, I think is incredibly important. The strengths that both these products have are awesome. I mean, I would go back and say one of the big positives in an IBC policy is you can use the word guaranteed.
Yeah.
There is a guarantee, there is a fixed interest rate, and in self-directing, there's a little more risk.
Yeah.
Or a lot more risk. I'm putting all my money into a deal that has 100% risk potentially. Let's say it's Bitcoin. Let's say it's real estate. I could lose it all. You can't lose it all in an insurance policy.
Yeah.
If you just leave it there and fund it every year, your worst case scenario is a good case scenario.
Yeah.
So that's pretty powerful as well. So that being said, I want to reiterate what Carson said. You need to meet with the team. You need to understand how they both work together. So let's talk about how you think, how you would propose maybe they work together, or we can talk about it together.
I think if you already have an old account, it's easy. You roll it over to self-directed every single time and you invest it. And then you slowly roll it over into Roth when you can.
So that, let's just stop there. That is where most of my clients come from, and I think is the most important thing to say. Because I think if we started with what is better, that question I think is a valid question if you don't have either things. If you don't have a retirement account and if you don't have an IBC policy, then I do think you can decide what is better to start with for you.
Well, sorry, before we get to this point, I had another idea of why IBC is better.
Oh, okay, here it comes.
To add on to it. you have to find the investment if you're self-directing.
Yeah.
You have to know what you're investing in. You have to have the team to help you, or someone to help you know what to invest in. You have to have a good enough returns, more confidence in the deal to make that investment happen. And you have to do better than the market, or else it's a waste of your time.
That's right. But I can kick the insurance policy's ass because it's only going to earn me 3, 4, 5%. So
Yeah.
I do have to do a little extra work.
Yeah.
There is a little more liability, but
Yeah.
I will crush it as far as returns go. And then, but yes, there are pros and cons to it.
It's true.
For sure.
That makes sense. So let's go back to then what you were going to say. So how do we do them together? And if you're in different situations, obviously you're going to have a different answer. But yes, self-directing a retirement account, I think, should be your number one plan if you have an old account.
That's right. So let's just establish that. If you're listening to this and you have a retirement plan, meaning some kind of IRA, SEP, simple, Roth, traditional, or an old 401k from a previous employer. By the way, I just want to share that stat. I've updated the stats on what's based upon today. There's over 55 million IRAs in the United States that have over $15 trillion. And there's over 2.5 million old 401ks that have a dormant $1.7 trillion. Actually, no, I'm sorry, 12.5 million accounts.
Okay.
So if you're in that boat, you're one of basically a quarter of our nation that has one of these old retirement accounts or IRAs. Setting up a self-directed IRA, controlling your money, is an easy first thing you should absolutely do if you are engaged and active and wanting to invest in things you know and like and understand. So that's kind of from the beginning.
Agreed.
Right? So you just said it. Just want to establish it. If you're that's the first place.
And to the question, to the question of who should do what, when do you do both, how do you do them together? That's step one. If we were to make this a step-by-step plan, I'd say, okay, you want to learn how to control your money. Let's look at your retirement accounts first and what you've already built up. What are your assets? Right. And if you already have old accounts, let's roll those over to self-directed and let's start lending it out. Let's go do whatever you want to do in investing with those accounts. And then let's look at, okay, well, now what are you going to do with your cash flow and the money you can save every year? Where do we want to now put the new amount of money that you can continue to save? Should we go more into the IRAs or more into policies or other places?
That's right.
So that's step two.
Step two is that. So step two would be creating and trying to create your new bank account.
Well, I would say step two is figuring out how much you save every year and then how much or what you want to use that money for, whether that's saving up for a kid's tuition, saving up for a car you're going to purchase, saving up for a rental property you want to buy. And then by understanding what you want to save up money for and how much per year you're saving up what amount for, if you are that on top of it, I guess you could say, then yes, then we'd look at, okay, how much should we be putting into a policy, and how much should we be putting into Roth IRAs or any type of retirement accounts?
So this step two, assuming you already have a retirement account, you should self-direct. Just to clarify, make sure I understand, is identifying how much money you can, instead of putting into a savings account, you can put every year into your new IBC savings account, basically.
Yeah.
And so whatever that number is, 10,000 a year, 25,000, 100,000, you come up with whatever that number is, and that is your new savings account. Just like when I first started, on my own, I had a certain dollar amount that I said I was going to commit to putting in my savings account. I wanted to just keep growing my savings account. Okay. So whatever that number is for you, you'd say, okay, this is the number I can put into my new IBC policy, and that I could use for loans and or other things that come up. So,
and here's what I would say about a pro for self-directing is if you are somebody who has a steady income, you don't save a ton and you want to put some aside and save and invest, probably putting it in a Roth IRA and keep self-directing it or leave it in the market, whatever you do, that's probably the best answer. Maybe adding a small policy just to diversify a little bit, but probably maxing out your retirement account is most likely going to be the best answer for you. And I would do that probably before a policy. If you are really hands-on and really want to control it, then I would say maybe more into a policy versus an IRA.
Look, I think the ideal scenario, if you're listening, is you're able to say, hey, look, I can put away, I can max out my retirement, which depends upon your situation. Your CPA can tell you which account, but whatever that is, $25,000 to $50,000 a year. Max that out. Then I would try to match that, at least match that, if not more. Another $25,000 to $50,000 or $100,000 per year in your IBC policy. If you're doing that, what that forecast and would look like from a retirement and wealth perspective is incredible. You do that for 10 years, just 10 years, the numbers would be very, very good for retirement and for your wealth. And so what I like about about IBC is you do have all those other benefits, not just the banking benefit, but you have have some life insurance benefit.
Yeah, that lasts forever, your whole life, and it always grows, so you know you're always going to be covered.
And I like that it's guaranteed, and I like that there's a fixed interest rate.
Yeah.
And so it's typically better than the bank.
Better than a bond even.
Yep, and it's safer than a bank. So those are a lot of the positives, right? And what are maybe some negatives for both self-directing and insurance? You want me to go on some, or you want to talk about some?
So I mean, in terms of, we kind of hit a couple of them, but I would add that you can screw up your policy if, to your point, you don't use it right or you don't know what you're doing with it. Whereas in an IRA, if you only can lose what you invested. So if you invested 20 grand in a deal and the deal goes bad, you lose 20 grand. In a policy, you put in 20 grand and you take it out and invest it, then you're going to lose that and the policy, if that makes sense. Use the investment and the policy.
Well, if you lost your money in that investment.
Yeah, and you don't pay it back.
Yeah.
So there's just added risk with you wanting to control your money in a policy versus not. But at the same time, you could look at it and say, well, now I get guarantees and I don't need to touch it, and I'm going to be okay to leave it here for a while and not need to worry about it. Whereas in an IRA, if it's sitting there doing nothing, you're going to be losing that money every year. So you do want the money to be working for you, so you can't really let it sit.
But I feel like that's the same for anything. I mean, I don't know how that's different than in any other investment. You want your money working for you always. I feel like the bigger risks associated to, well, I'll just pick on mine. The bigger risks associated to self-directing is I see people leaving the stock market, loving the idea of investing in real estate or something, and then the money's here, and then they don't find anything. So it sits and does nothing.
Yeah.
So now you earn nothing. Or they invest it with somebody they don't really know, and they lose it all. There's higher risk because there's very little, if any, regulation when dealing with alternative asset classes. So that's why self-directing is not for everybody. Only 5% of Americans do it, and I believe only 15% probably should be doing it. Not 100% of America should be doing it. Typically those that are more active in their business and financial lives. So I feel like that's a big negative, is if you aren't active, meaning understanding and educating yourself on how to invest your money in an IRA and choosing it, that's a big negative.
I like it. So to sum up here, to wrap up, what do you want your listeners to know in terms of self-directing and IBC and what they should be doing moving forward?
Well, really simple. If you already have a retirement account and you're not happy with returns and you are actively involved in some other kind of asset class that you are comfortable with, be it real estate, Bitcoin, businesses, take action, do something different. Use your retirement account, set it up with a company like ours to then move it through. We're just basically a holding point, like an escrow company almost, to allow you to move that money and invest in what you want. That's step one. Step two, in my opinion, is get your IBC policy set up. Why? Because it becomes your new banking entity. And what's great about it is, even if you like the concept but you're like, hey, look, I'm saving $50,000 a year, but I don't quite know how much I can save for the next 10 years. Do $10,000 a year or whatever the number is. Commit to a number you know you can do. Start doing it now, because what I've learned, that people who take action on the things that I've been teaching for the last couple decades, 5 and 10 years later, they thank me. They at first think, oh, it's too small. I'm only saving 10 grand. I'm only putting $6,000 away. After 10 years of it compounding and working these different systems and these vehicles that are approved, you will be surprised on how much wealth and or monies you've saved up. Way more than anyone else you know. So those are the next steps, in my opinion.
I love it. Awesome. So to wrap up, we always do sweet, sour, and service in our episodes, which is a little thing we do as a family where we share a sweet, a sour, and a service in our lives over the past couple of days. And using the podcast just to be quick and easy, we always share one or two of them. So
we can share all three.
We can share all three.
Whatever you want.
But I will share a sweet that this weekend we're going to go to Disney World and go hang out with the family and enjoy a cool trip. So we're excited about that. We're heading out on Friday.
Yeah, I'm really excited about it. It's going to be fun.
Yeah, and I'll leave the suite to you.
Well, my suite was last night. Carson's younger brother, Cole, just opened up his mission call, and he is going to be serving in the Ecuador West Quito mission, and he's leaving in August for 2 years. And so it's a huge suite. Most people don't know or maybe unaware, but I served my mission 25 years ago in Ecuador, Guayaquil, a city close to where he's going to be serving. And that's not normal. It's not normal to see your kid go to a similar country as you or similar place as you. And so I'm blessed to be able to see that and to see him experience the excitement of going to his mission. And couldn't say enough great things about that suite that happened last night for our family and for me. So.
Yeah, I love it.
Anyway, so thanks for listening.
See you guys next week.
We'll see you next time.